Hi guys, welcome back to the channel. My name is Dave, and yesterday I reviewed JEPY and QQQY, two brand new ETFs from Defiance ETFs. Now these are brand new to the market, and they use 0 DTE options. They set the position up right before close the night before. The next day they manage that position. They do this with in-the-money puts, and I'll link my video up above if you want to watch that and understand kind of how that process might play out. But the goal here is to collect time decay or theta decay. And if they do this every day, they collect all this over time, and they distribute it out to us, which is so nice. And based on that first distribution rate, JEPY was around 55%, and QQQY was even higher. Pretty impressive. But not nearly as impressive as JEPD, which is what I'm going to come out with in 2025 or 2026. So like and subscribe so you can get this ETF, because this bad boy is going to offer over a 100% distribution. It's going to be amazing. So I'm going to do this with something called a gut spread. Instead of just doing one in the money put, I'm going to do an in the money put and an in the money call, doubling my theta decay, and we'll see how it works out. I actually did one last Thursday as a guinea pig for this channel, and we'll see how it turned out on Friday. So if that is what you're looking for, please stick around. Whoop. So I hope you did sense my sarcasm in my opening piece there, but when some of these new funds come out and they're blasting out this very high distribution rate, I hope you understand that they're not going to be able to maintain that and protect the net asset value of the fund. It's going to be very difficult. If they could actually protect that value and offer a 55% distribution yield, they're going to be working for a hedge fund making 8 figures. They're not going to be on here blabbing about it trying to manage an ETF. That's my personal opinion. So anyway, very difficult. But that doesn't mean we can't learn a little bit of something from each one of these ETFs, and looking at something like a gut spread is kind of fun. So let's check out my trade. So first of all, what is a gut spread? Well, if you watch that video on JEPY and QQQY, we see that they use an in-the-money put, which is similar to a covered call strategy. We're going to limit our upside with that strike price. At the same time, we're going to have the benefit up to that strike price if the stock or index rises. And if it drops, well, we have no protection there. We're going to lose out if the stock or index drops significantly. Well, with a gut spread, we're going to do that on both sides. We're going to sell an in-the-money put, just like they did. On the opposite side, we're going to sell an in-the-money call. Now, our goal here is to not have the stock or index move too wildly in either direction. We want it to stay in between those strike prices. If it does, we keep maximum profit, but we're collecting theta decay from both of these sold options. Now, if it drifts outside of there, we start to lose, and there's nothing to cap our loss here, so we could lose significantly if it moves wildly outside of our strike prices. So that's definitely a risk associated with this. So we want no significant movement. That's the goal of the gut spread. So here are the two index options that I sold. SPX index options prior to close on Thursday night last week, with it sitting right around 42.57 prior to close. And let's not forget, Friday morning, the jobs report was coming out at 8:30. So just to add a little bit of drama. Now, a lot of that volatility would be reflected in these option trades, but I definitely felt like we were sitting on the edge of a knife Friday morning when that jobs report came out. It could go either way, right? Because it's an indicator of where we're going to head with interest rates, and people get very excited. So ill-timed, perhaps, but I was willing to take the chance for this channel. So in this case, I sold open my put contract for the next day at 43.10, and I sold open my call contract at 4,200. So the goal here is to keep the index here between those two strike prices. So I'm pretty well balanced to each side with it sitting at 42.57. And you can see the max gain down there is $620. That $620 is all mine if it expires between these two strike prices. Now, that is just time decay, right? I can't get a benefit from it going any higher or lower. They're kind of offset each other as they oscillate between here. But if it goes outside of that, I can receive a lot of pain, right? That's where the max loss shows unlimited, right? If this really plunges after that jobs report comes out or throughout the day or rises considerably, I could really be punished. So anything for this channel. Now, the break-even points are 41.93 and 43.16. So the credit that I'm receiving above the strike prices on either side, right? That makes sense? So that's the goal. And I set it and I forget it. And I launched into this trade coming into Friday morning. So I was actually on the road the next morning when the jobs report came out. So I saw that, and my first reaction was, ooh, this is going to be a negative day. I might have to get out of this trade rather early. But the market reacted negatively, and then it quickly reversed, which I don't understand. Maybe if you're a lot smarter than me, you do. You can explain it to me. But we really started to rally, and it wasn't until about lunchtime when I kind of sat back down at the computer and actually thought, maybe I should get out of this trade, as we made it back to about 42.50, and then we just started blowing through 42.75 up to 4,300, and I'm like, okay, well, time to get out of it. So I did exit the position right around noon. I will show you my numbers now, so you know I'm not lying, but made about 137 bucks, I think, and got out. And then the market continued to rally a little bit, all the way up to 43.25, which would have been a loss for myself for a large part of the day. And then at the very end, it settled back down about 43.0850. So if I was patient, I would have kept all of my premium. So a lesson learned? No, I don't think so. Actually, I would have done the same thing. I would have got out early with all the momentum in the market. That's what options traders do sometimes. You get out, you take your small profit, you went for the hills, you reset for the next day. So I wouldn't have changed anything based on the momentum in the market, but it does show you that with patience, or maybe just laziness, if I wasn't near a computer, I couldn't have ruined my position. I would have kept all 600 plus bucks and had a much better sushi dinner than the one that I did have. But I was able to afford one sushi dinner for the wife and I, so worked out okay. So that's my example of a gut spread using 0 DTE options in a similar fashion to JEPY and QQQY. Now, JEPD is going to have to be put on hold while I further refine this strategy so I can get to my 100% distribution yield. Soon coming to you on your favorite trading platform in 2026 or 2027. We'll have to see how that plays out. But nevertheless, hope this helps. If you have any questions, ask down below. I'll see you next time. Like and subscribe if you like this type of thing, and we'll see you next time. Take care. Whoop.